Hey, welcome. I'm Jay. This is smarthelping.com. I got a really cool real estate financial model I've built here. It is great for apartment buildings, multifamily, or self-storage. It's a 15-year model, joint venture capable. What this model is really perfect for doing is acquisitions, also new construction, options for financing, options for up to 2 refi events, option for exit value. There's also a lot of focus on value add in the rent roll section and when you're filling that out. Um, it's also great if you have if you're doing an acquisition, but you're also developing new units, and then those start at some point in the future. So it's very flexible. It's the best real estate model I believe I've ever done. It's got two waterfall options. One's based on IRRs, the other's based on a simple preferred return. You can see how they vary in this section here. So what I'm going to do is walk you through every single input assumption, and I'm going to fill this out along with you. So when you're doing it for the first time, you can do it with me, and it'll be easier to use for the first time, and then you'll get a feel for it. So let's start with so company name. We'll just call it RE Ventures, and then launch year. Let's say 2024. Let's say we're going to run it for the full 15 years, so exit 2038. We're going to include the terminal value. Exit cap rate, let's say 6%. Any selling fees, let's just put, who knows, at the time, in 15 years, what, 5%. Cash sources, so this is saying, do we want to use a construction loan or a P&I loan when we, put in our initial investment requirements? And we're going to put yes here. Taxes. Now look at this. I've actually got correct logic for depreciation, recapture, capital gain, and regular income tax rate. So income tax rate, we can put that at, let's say, 30, long-term gain at 10, and depreciation, recapture tax rates a maximum of 25, up to 25%. We'll put 25 here. And you don't have to include taxes. You could always zero these out. Okay, next tab, development and acquisition. So this is the most robust schedule I could think of. And what you can do is got 6 sections. The first section should always be used for acquisition costs, if any, because there's acquisition fees tied to this for the GP, if applicable. If this is a joint venture, you could put those in on the GP tab we'll go to next. So let's say in this case, we're going to model out acquiring a new building and also doing some renovations and adding some units. So let's say we buy it for, let's say, $8 million. And let's say we're going to finance 50% of the purchase price. And so we make sure this is yes. We put 50% here. And this is going to flow to the debt schedule, which we'll get into. So you can see here, we're drawing 50%. And then let's say there's some closing costs, and you can put anything else in regards to the initial purchase here. And this doesn't have to be in the first month. This could be at any month in the whole forecasted period. Okay. Development. So let's say we're going to buy it, then over time we have some construction costs. Let's say, we spend $50,000 a couple months. Let's also say that these are going to be 80% financed. So we make sure this is yes. We put 80% for here, and that's fine. Now I've put really robust options here. You can put, what do I got? Up to 22 slots for each section, and these are all your just initial costs. So there's a bunch of these. There's also, let's say you're gonna buy land. You could put land here, and then new construction. That's fine too, with the construction costs. So this is very robust, and one of the best schedules I've ever built. This is just showing you, this is doing the math for what's actually being financed versus equity. Okay, so we got these costs. Let's go to management fees. So if this is a joint venture, let's say the GP potentially could have an acquisition fee. So on the purchase price, let's say it's 1%. Other fees upon purchase, there could be some other things, let's say 5,000. And you can put the month that happens based on the month of the acquisition. So let's just say it's January 2024 in this case. Ongoing asset management fee, so that's going to be a percentage of gross rental income. Let's say 1% there. Disposition fee if we do a refi, the first refi, so that's going to be on the value based on a cap rate at the first refi. So we'll say 1% there. Second refi 1% and exit 1%. So the management potentially could take fees on all of these events. Other fees, you've got development, and then these are all of the different sections here. So you've got development, other cost 1, other cost 2, other cost 3, and land. That's what this is here. So you could potentially take fees on all of these costs if there are any. So I've had a lot of people talk to me about fees and how to implement them. So I've just put in as many as I've ever seen here. So you can account for that as needed. Depreciation, development, acquisition. So this where you can define, here's your main sections of costs, and you can give them a useful life. Let's just call this, we'll just easy terms, 30 years, 30 years. So what that is going to do is start the depreciation, and this is actually going to start as soon as, well, it will start when you start collecting rent based on the rent roll assumption. So this will this number here will populate once we start getting the details into the rent roll. So I'll go back to that. But here you can see there's also going to be depreciation recapture logic. And then, so depreciation recapture is simply, you have a cost basis here, it's 8.3 million. There's depreciation that happens over time. If you sell the building for more than what the book value is at the time of exit, so let's say it's worth, you've depreciated enough that the 8.3 million is now worth 4.1. If you sell it for like 9 million, you have to repay taxes on between the 4 and the 8.3 million. That's depreciation recapture. And then anything above this 8.3, you have to pay capital gains tax on. So all of that logic is happening right here automatically. And you'll see once I fill in the model, you'll see numbers come in here, but I haven't filled in the whole model yet. Rent roll. So let's do a rent roll. Let's say the current acquisition price is 8 million. The current NOI is, let's say, per year, 3%. Let's say it's 700. Okay, 8.8% entry cap. This is not going to drive anything. This is just for your own analysis. Every column here that says drives model is a column that is used throughout the model. If it doesn't say that, then it's just for your own purposes. So like these are not going to go anywhere, but it'll be used for analysis. Let's say we got 2 bed, 1 bath. We got 2 bed, 2 bath. And all we're doing here is filling out the types of units. And because I said this is good for apartments, it's good for multifamily, it's good for self-storage, all of those types of real estate properties have different unit types and potentially different counts for each of the types of units. So we're going to fill that out here. Let's say 3 bed, 1 bath, 3 bed, 2 bath. Let's say studio. Let's say 3 bed, 3 bath. Let's say 4 bed, 2 bath, 4 bed, 3 bath. Whatever, you could fill this out all the way down. I put slots for, how many do we have here? 25 different types of units. Not total units, but 25 types. Then we do the existing unit count. So let's say we've got 5 of these, 7 of these, 15 of these, 2 of these, 1 of these, 10 of these, 15 of these, and 80 of these. Now, 135 total units, and my numbers here are arbitrary. I'm just making these up as I go, but you can get the picture. Then you put in the current monthly rent of each. So let's say these are, let's say 950. 1100, 1250, 1350. Studio do cheaper 800. Three beds, three baths, a little bit more, 1400, 1450, and 1750. So there's a current monthly rent. The current occupied units, let's say, you know, maybe you only get 10 of these. So there it's going to show you what your current monthly rent is based on that, the current occupancy rate, and the current weighted average occupancy rate. You can also put in, let's say if you're going to be developing a couple new units as well, we'll put in here new unit type 1 and 2. So there's two different unit types here. There's nothing for these because they don't exist yet, so you just leave that blank. Okay, now we go up here and note the key acquisition stats. So once we start filling out the expected pro forma, we're going to see our value add opportunity and what percentage increase we are going to have potentially in a stabilized environment based on the current actuals. So what we want to do first is column J is the market monthly rent per unit. So that's just saying what the market rent is for these units. Let's say, I'm just going to say in general, these are, 20% more than what you're actually collecting on the existing ones. We'll paste value there. And then let's say these new ones, the market is going to be, I don't know, let's put 3,000 and 3,200. Okay, and then we have pro forma starting monthly rent per unit. So this is what you plan to actually charge, which may be more than the market. It might be less. It could be more than existing. It's probably not less than what you have existing. So here, let's say maybe we'll raise the rents a little bit, 960, 1250, 1300, 1400, 875, 1450, 1500, 1850, and then maybe on these 2800 and 3000. Okay, so then you can see, well, what's my pro forma rent versus the market? So I'm 15% under here, 5% under here, here. And then, oh, we got to fill out the pro forma before these will populate all the way. And then what's my pro forma versus current? Well, I'm 1% above the 950, 13% above the 1100. So it's showing you, you can see where where do you plan to be relative to the market, and where are you relative to the existing rent? And you'll see that here and here. Now we go out and fill out the pro forma unit count. So here is where, we do 5, 7, 15, 2, 1, 10, 15, 80, and then let's say we're going to build 5 of these units and 5 of these units. Okay, and what do we think are occupied of these to start? Let's say, right now there's 5, 7, 10. Let's just put in what's currently existing, and then maybe these will start at 3 and then work up to 5. Okay, so here's our occupancy weighted average. And now you can see that I filled those out. We now can see our pro forma versus market, the aggregate. So on average, we're 11% below market on the rent, and we're 10.9% above the actuals. Okay, we keep moving down here. And again, all these numbers I'm putting in here are going to drive our pro forma cash flow, the revenues, well, not expenses. This will drive all the revenues over time. Okay, so average monthly improvement in occupancy. So this says, right now, here's our occupancy rates to start that we think that will be. We could say maybe we improve 0.2% per month. And then we could say, what's our stabilized occupancy, which is our long-term rate? Let's say maybe we think 98% is what we can achieve over time. So then you can see here the amount of months. Well, actually, these are already 100, so we'll put 100 on these because we think they're going to be occupied the whole time. So this is the amount of months based on this rate that it'll take to reach full occupancy or stabilized. And again, you could change these and these numbers will change. You can see the stabilized units occupied right now, or based on this happening actually, and then the stabilized monthly rent. We could put annual rent increases in here too. Let's say 1% every 12 months. And then let's say month rent begins. So this is very important. So month one of the model is January 2024. We can put in, and this is really important for the new construction ones, when does each type of unit actually begin collecting the rent that we have starting here. So let's say we're doing construction. Let's say these all begin in month 7. So we go here, 7, whoops, 7, 7. And let's say these take a little bit longer. Let's say they don't start till like month 15 on these last two. Okay, so that's your rent roll. And you can see here we've got a 55% potential to increase the annual rent, or increase annual rent by 55%. Occupancy can be improved by 40%, and then the weighted average rent per month per unit can be improved by 10%. So there's your value add. That's how you're going to really increase the value of the building. OpEx. So here we just have, things like utilities, repairs, and maintenance. What else? Repairs and maintenance, real estate taxes or property taxes, maybe a manager, depending if it's self-storage or apartment, or multifamily, depends on what you might have here. And you can just put in, other expense items here, and you select the start month. So here we know utilities might have to be paid right out upon purchase if it's acquisition and you're doing some renovation. So we'll put January for these. Maybe repairs and maintenance doesn't start till later. May. Property taxes starts right away. Manager, put May, and other expense items in May. Now the starting monthly cost of these things, you can just put in here. I'm just putting in 3,000 a month for this, 5,000 a month for this. Property taxes, it'll be dependent on the property, but we'll just put in monthly amount 10,000. Manager 1,250. Other expenses. This could be like, you could put in here also. We'll just put 3,000. You could also have like property management fees. Okay, we'll start those in May as well. That's usually a function of your rent. Let's put 2,000. And actually, I didn't look at the rent roll. What did we actually do here? So we started at 1.8. We got up to 2.9 stabilized. Our starting monthly rent's 183. Based on our occupancy expectations, we had 157 actual. Okay, so this numbers at least makes sense. Just making sure. All right, and then these you can just fill out a date if you don't want to see the number errors here. Just make sure there's a date in column C. All right, debt schedule. So here's really important. Now if this is just an acquisition and you are not doing a construction period, you would put start month of the loan would be the month of acquisition, and all those costs happen in that month. You would put interest only period of 1 and a 0% interest rate, and then you can see how this just flows right over to the P&I, the first P&I loan. And here you just put, maybe 5% interest rate, 30-year term, maybe 1% prepaid penalties. Okay, and then let's see here. Where's the principal and interest should be coming in here. We mark this as yes. Okay. Okay. So if we have refi 1 as yes, we got to put in a refi month. So we think we're gonna run this, let's say, for 3 years. So let's say month 36. Okay. So there now, because these numbers depend on that. So now you got a P&I loan coming in here. There's going to be a refi. We'll put cap rate for the refi 6%, maybe 80% LTV. We'll just put in 6% interest. This is going to be a 30-year term, 1% prepaid penalty. And then again over here, if we do a second refi, now we got to enter this. Let's say this happens at maybe month 120. And this cap rate is 6%, LTV is 80, interest rate 6, term 30 years, prepaid penalty 1%. So you got all these potentials for refis going on. You could forecast what that looks like up to 2. Now, and this could be 1 now. You can see if there's no interest, it's just an acquisition loan. There you go. Now, if it's new construction and there's going to be maybe an interest-only loan until your operations start, that's fine too. What you would do is put in this number is going to be the first draw month, and then the interest-only period, let's say it's going to be for, in this case, 6 months. There's our draws. Let's say the interest rate on this is 8%, and we're going to accrue the interest, so there's actually no payments happening, and this just will roll into the P&I loan on month 7. Okay, and you can see this percentage, 4 million, 40, 40, 40. That's based on this 50%. Let's say we financed 80%, and we go back to our debt. Now look, we're drawing 6 million instead of 4, so the draws are more on that one. So that's how that works. We'll put this back to 50. See, now it's back to 4 million. Okay, so I've actually filled out everything, so everything should be flowing. If we go to the executive summary, we can see here's our gross rent. Here's our gross profit, same. Here's our operating expenses, total expenses, net operating income, debt service coverage, very important here to figure out what's our NOI relative to debt service or debt obligations. Other cash flow, so you have your GP fees, taxes, CapEx, debt service, proceeds from exit, and net loan proceeds and repayment. So this is all your refi and repayment on the exit of any loans of remaining. Then total cash flow, cumulative cash flow, an annual IRR, equity required, equity multiple of the project, and project ROI. Okay, and we'll get into the cash flow waterfalls here in a second. But what I want to do is go back to this. And yes, we know these are going to be in error until I actually fill out the input, so that's okay right now. So we can see our value add is here. And then you can see here's the depreciation or capture. So look at this. You've got a value of, oh, oddly enough, exactly half. So we've depreciated exactly half of the initial cost. Let's say if these are 31, it'll be different now, so you can just see different numbers. So 4,016,000 is the amount to go to get back up to the cost basis of 8.3. So that's depreciation recapture. So a tax rate of 25% is going to apply to that, which you will see in the income statement. And then the remaining capital gains above the 8 million is 34, and you're getting that million from this 42 million, and that's less any selling fees that happen. So if we add these together, it's 38,548. And if you do that, this is essentially what you're liable for taxes on these amounts. Okay, let's go to the cash flow waterfall 1. So you've got hurdles. Let's say that this is a joint venture. No, if it's not a joint venture, that's fine. You can just assign the LP 0, 1, and 100 here, and then just put, well, actually just be this. You can just leave it like this if there's no other investor, and you can see the cash flows down here would just be what they are for the entire project. And yeah, that's it. Now these numbers, this IRR is based on a monthly IRR converted to annual, so it's a little bit more accurate than doing the annual IRR here, but it's okay. to have both. You just, this is the more accurate one on a monthly basis. So, uh, and then you've got annual, here's the annual summary. Now, if it is a joint venture, let's put in some hurdle rates. So 10, 15, 20, and let's say the LP up to this is going to get 100%. And then second hurdle, maybe they go down to 80, and then maybe 60, and then maybe 50-50 after that. And the initial contributions, let's say the LP is doing 95%. So now you've got some numbers showing into the hurdles. And all this means is up to 10% IRR received, the LP is going to get 100% of the cash flow. They're contributing 95% of the cash flow here. And then from 10 to 15, they're going to get 80. From 15 to 20, they're going to get 60%. And again, the waterfall structure is trying to incentivize the GP to give really good returns to the LP. And if they do, then the GP is going to get promoted in higher shares of what's available for the cash flow. And you can see the summary down here. Now you can see numbers popping in. You can also see the GP fees happening here over time. And as we scroll over, the first refi event, we get down into the deeper, or basically into the third hurdle after the refi in the 36 month. So now the GP is getting more share of the cash flows as we move forward. And there's just a small, a negative month there. That must be right after the next refi. Yeah, it is, because there's a refi cash happening here. So debt service is a little bit bigger than NOI for this month, so you just see a little bit of a negative. But then we're back into the last hurdle quickly. And then you can see exit in month 180. Net exit value is 2.8. That's after paying all the debt, and that's distributed. So we see the IRR for the LP, the GP, the equity multiple, and you can also do a discounted cash flow analysis for both parties as well. You've got the annual summary. So here's the cash flows for LP and GP on an annual basis. Now, cash flow waterfall 2 is a little bit different. Here. So in this case, we've got, let's say the investor is contributing, and you could change this. You can make this 100% in this case, and then maybe the profit share after the pref is, let's say 70-30. And let's say the pref return is 9%. And then do we want to add any shortfall to investor equity? So this means if there's not enough to pay the pref, does that compound or not? If we hit yes here, and then start clean each year, hit no, and then reduce equity balance, here we can put yes. So in this case, starting clean each year means if there is a shortfall, you don't care about it, and you just, whatever cash was available is distributed, and then you just move on to the next year. If you hit yes here, you can see how that happens. And so no change in equity, no changes in the pref. You just move forward. And then this would be no, if you're starting clean, you're not going to be adding this. And then reducing equity balance with profit share. Now in this case, you can see, so in the first 6 months, there is some contributions required. So the preferred return is going up based on that. But then if we're reducing equity balance with profit share, that means this 70-30, some of it's return of capital, which we're calling out right here, repayment of equity. And so that is reducing this equity balance, and so the return's slightly going down, and then eventually, here in the refi event, it actually finally gets all paid off, so there's no more pref. And when there's no more pref, then all the cash flows after that are just split 70-30 between the GP and LP. Now, if this 9% pref, let's say you are adding this to the equity, any shortfalls, then this goes up. There's no available distributions, so it's not going up by a very little amount here, 26,000. We're starting clean each year. Let's put no. Now now you can see the basis is going up. And the return due is going up a bit more now. And let's say we don't reduce equity balance, so now you can never go below whatever you contributed. In that case, everything's profit distribution. and the pref return is due the entire time. And you can see what the IRR and equity multiple is as you change those numbers right here. So the biggest impact is this one has a pretty big impact. If you hit yes here, you can see that, well, 77 to 77.6, it changes a little bit. This has a less of an impact. Yeah, it's not even changing the percentage. It's less than 0.1% change. Um, and then starting clean each year has a bit of a change as well, 77 versus 77.6. Okay, but anyway, this can apply to whatever cash flows your deal has. Pref return, and you can see down here, you can see the total GP share, LP share, in these two rows, and also discounted cash flow analysis for each based on a monthly discount rate, and then annual waterfall based on the second option is this. So this is really cool to see, well, how does the IRR hurdle compare to the preferred return model with options for different configurations. And then that will all go back to the summary. You can see the comparison here as well. Visualizations, we got annual revenue by type. The other ancillary income, oh, we didn't fill out ancillary income. Let me go back to the rent roll real quick. So there's ancillary income here. We could do the average monthly amount per occupied unit. So let's just put in $6 for each of these. And let's say 20% of the units have this, or, currently. And since there's about 100 units occupied, that's saying there's roughly 20 units that pay each of these fees, and this is the monthly fee. So this is the monthly rent per unit. This is the total monthly ancillary income based on this, and this will then be applied to the future rent. So now if we go to our visualization, you can see there's a little bit of ancillary income there. And that'll be adjusted depending on how you just define those numbers. You've got annual net operating income, annual revenue versus expenses per period, which is yearly here, annual cash flow versus cumulative. So these boxes are showing what happens per period, and then this is the cumulative effect of everything. You've got balance sheet cash flow by month, asset liability owner's equity, debt service versus NOI, and then average monthly revenue per available room, which is an interesting key metric for apartments and multifamily. This would obviously be per available unit if it was self-storage, but just different text, but same concept. And then your average occupancy. So there's where we're reaching our stabilized occupancy finally, based on our percentages we put in. Monthly detail, this shows you the breakdown of all the things that are affecting your pro forma. So you've got your acquisition, development, all these costs. You've got your rental income. So total rental income, vacancy, gross rental income, ancillary income, total revenues here over time. And this is all based on the assumptions we just entered. You've got operating expenses. You've got net operating income. Here's your valuation bases for the different refi events, which potentially could have different cap rates. Right now they're the same. CapEx, cash flow before financing, and then you've got your proceeds from loan draw, any accrued interest, which you'll just flow to the balance sheet accordingly. Right now we do accrued interest, so there's no actual payments. And then you've got the P&I of the initial loan. You've got your refi 1. So here we're repaying this. We've got the refi happening here, the new debt service. And then you keep going, and then there's the third one. 37 million net, and then you got new debt service again. And then on the exit, you see that's repaid with our exit proceeds here. And you've also got some taxes. You've got selling fees, disposition fees for the GP, which those come out of the project. These GP fees come out of the project and flow to the GP. You get your debt service coverage and then final cash flow. So everything's accounted for on a monthly basis, all relevant items. Here's your key metric stat. Annual details, the same thing, but on an annual basis. So here you can see what the annual numbers look like. And I've also put in a 3-statement model so you can see income statement on an annual basis. Here's all the depreciation recapture logic and taxes accordingly. We've got a balance sheet so you can see cash, your asset, accumulated depreciation, liabilities, and LP and GP stock or equity, retained earnings, and all that balances out. You've got your cash flow statement, which is kind of like a nice uses and sources where you can see, what you're spending, how is that funded, with selling. And I put stock here. It's basically you're just selling equity. You can change the terms as needed. Some debt, net change in cash per period, and that's the model. That's everything. Trying to think if there's anything else that we want to put in here or show. No, that has everything here. That's fine. Yep, that's it. So this is really robust. You can use this for all kinds of things. If you want the template, the link is in the description box below. I'll also post this to vendor sites. It's going to be included in the real estate bundle as well. I'm going to list this at $125, a one-time fee. Trust me, with these models, it's one of my biggest billables. To build something like this, usually it takes thousands of dollars. I try to build a template based on all of the experience I've had with real estate and try to put as much robustness and flexibility in here as possible to reduce the need for customization. So I think this is a really, really valuable template for any real estate investor that's either a single operator that's investing their own money as well as financing, or for GP, LP situations, or just joint venture syndications in general. Has a lot of logic for that. So be sure to get the template. You can follow along with me as you fill it out, just so you can see how everything works. And I think this is a really, really awesome template. I'll see you guys on the next one. Don't forget to like the video and subscribe.